Breaking news that every retiree and senior in America needs to hear right now. If you have recently stopped working, or if you are planning to retire in the next few months, or even the next few years, what I am about to share with you could save you thousands of dollars, or cost you thousands if you ignore it. The IRS has rules that most people never learn about until it is too late, and when you stop working, those rules suddenly become very personal. 5 specific things happen the moment you quit your job, and if you are not prepared, the government can legally take a significant chunk of what you spent your entire life building. Most people assume that when they stop working, their tax problems go away. No more employer, no more W-2, no more stress, right? Wrong. In fact, for millions of Americans, the first full year of retirement brings the most confusing and costly tax situation they have ever faced. Here is why. When you were working, your employer was quietly doing something very important for you every single paycheck. They were withholding federal income tax and sending it straight to the IRS on your behalf. You never had to think about it. The money was gone before you even saw it. But the moment you retire, that automatic system disappears. Nobody is withholding for you anymore. And if you are not careful, you can end up owing a large lump sum to the IRS in April, along with penalties for not paying throughout the year. This is the first thing the IRS effectively takes when you quit working, and it catches people off guard every single year. I want you to pay close attention because this next part involves your Social Security benefits. Many retirees are genuinely surprised to learn that their Social Security income can be taxed. The money you paid into the system, your entire working life. The money you were promised can be partially taxed by the federal government depending on your total income in retirement. If your combined income, which includes your Social Security benefits plus any pension, any withdrawals from retirement accounts or any part-time work, exceeds certain thresholds, up to 85% of your Social Security benefits can become taxable. For a single filer, that threshold starts at just $25,000. For married couples filing jointly, it starts at $32,000. These numbers have not been adjusted for inflation in decades, which means more and more retirees are being pulled into this tax every single year. This is the second thing the IRS can take from you in retirement, and most people do not see it coming until their accountant delivers the bad news. I want to make sure you hear about number 3, because this one has a deadline attached to it that the IRS will not remind you about. When you reach age 73, the federal government requires you to start taking money out of your traditional IRA and your 401k accounts every single year. These are called required minimum distributions, or RMDs. The amount you must take is calculated based on your account balance and your life expectancy, according to IRS tables. And here is the critical part. If you fail to take your RMD on time, or if you take out less than the required amount, the IRS can hit you with a penalty of up to 25% of the amount you should have withdrawn. That is not a typo. 25%, on top of the regular income tax you will still owe on that money. Now, the Secure 2.0 Act did make some changes to RMD rules in recent years, including adjusting the starting age and making certain Roth accounts exempt from RMDs during the account owner's lifetime. But many retirees are still operating under the old rules and have not updated their financial plan. If your retirement account has grown significantly and you have not spoken to a financial advisor about your RMD strategy, this is urgent. The IRS does not send you a reminder letter. You are responsible for knowing this deadline yourself, and missing it can be devastatingly expensive. If you are finding this information helpful, and you want to make sure you never miss a critical update that could protect your retirement savings, now is a great time to hit that like button and subscribe to this channel. We cover IRS updates, Social Security changes, and retirement financial strategies specifically for seniors and retirees, and we release new content every week. Turn on your notifications so you never miss an important update that could directly affect your money. Now let us talk about number 4, and this one surprises even financially savvy retirees. When you retire and you have a pension, or you start drawing from a traditional retirement account, every dollar you pull out is considered ordinary income by the IRS. That means it is taxed at the same rates as a regular paycheck. This can push some retirees into higher tax brackets than they expected, especially if they are also collecting Social Security, earning rental income, or receiving investment dividends. What makes this particularly dangerous is something called a tax torpedo. This is a situation where taking out too much from your retirement account in a single year not only increases your tax bill directly, but also causes more of your Social Security to become taxable at the same time. The combination can create a much higher effective tax rate than most retirees plan for. And it can happen to people who are nowhere near what they consider wealthy. A retiree with $200,000 saved and a modest Social Security benefit can easily stumble into this trap if they are not careful about how and when they withdraw their money. The fifth thing, and many people consider this the most important of all, because it is the one with the most flexibility. If you act before it is too late. When you stop working, you lose access to certain tax-advantaged contribution opportunities. During your working years, you could put money into a 401k or IRA and reduce your taxable income at the same time. Many employers matched contributions, which was essentially free money. That all stops at retirement. But what most people do not realize is that if they have any earned income, even from a small part-time job or self-employment, they may still be able to contribute to a Roth IRA and continue building tax-free wealth. Additionally, the window for doing Roth conversion strategically becomes critically important in the early years of retirement, particularly if you retire before age 73. Those years when your income is temporarily lower can be the perfect time to convert money from a traditional IRA to a Roth IRA, paying taxes now at a lower rate so that future withdrawals are completely tax-free. Many retirees miss this window, entirely because nobody tells them it exists, and they end up paying far more in taxes over the long run than they needed to. The very first thing you should do if you have recently retired or are planning to retire is set up voluntary tax withholding on any income you are receiving. You can ask the Social Security Administration to withhold federal income tax directly from your benefit check. You can also set up quarterly estimated tax payments to the IRS so you are not hit with a big bill and penalties come April. The IRS Form W4V is what you need to request withholding from Social Security, and it is free and simple to fill out. Second, get a clear picture of all your income sources in retirement and add them up. Use that number to determine whether your Social Security will be taxed and by how much. Third, contact whoever manages your retirement accounts and confirm your RMD schedule. If you turned 73 this year or are approaching that age, do not wait. Fourth, talk to a tax professional or financial advisor who specializes in retirement planning about your withdrawal strategy. The sequence in which you draw from different accounts, taxable accounts, traditional IRAs and Roth accounts, can make a massive difference in your total lifetime tax bill. And fifth, if you have any earned income at all in retirement, look into whether a Roth conversion makes sense for your situation. Imagine two neighbors who retire on the same day with the same amount saved. One of them does nothing different, draws from their retirement account without a strategy, never adjusts their withholding, and misses their RMD 1 year. Over the next decade, that person pays far more in taxes, gets hit with a penalty, and watches inflation and taxes slowly chip away at their savings. The other neighbour spends 3 hours with a financial advisor, sets up a smart withdrawal strategy, starts a Roth conversion in year 2 of retirement, and adjusts their withholding properly. That neighbour keeps tens of thousands of dollars more over the exact same period, simply because they knew the rules. The IRS does not play favourites. It does not care that you worked hard your whole life. It simply follows the rules, and the people who know those rules protect themselves, while those who do not end up paying more than they should. The information in this video is more important now than it has ever been, because the rules around retirement taxation, required minimum distributions, and Social Security are continuing to evolve. The Secure 2.0 Act brought changes that are still being phased in. There are ongoing discussions in Congress about further changes to how retirement income is taxed, and inflation continues to push more seniors over the thresholds that trigger Social Security taxation, even when their purchasing power has not actually increased. This is not a situation where you can set it and forget it. Retirement financial planning is something that requires attention every single year, especially in the first 5 years after you stop working, when the decisions you make have the longest lasting impact. If you have a spouse, a sibling, a close friend, or a neighbour who is retired or approaching retirement, please share this video with them. The information here could genuinely protect their financial security, and most people never hear it until they are sitting across from a tax professional in March wondering why they owe so much money. You now have the knowledge to avoid those painful surprises. The 5 things the IRS takes when you quit working: the loss of automatic withholding, the taxation of Social Security, the mandatory required minimum distributions, and their steep penalties, the unexpected tax bracket impact of retirement income, and the missed opportunity for smart Roth strategies. Are all manageable if you plan ahead. They only become devastating when people are caught off guard. Subscribe to this channel right now and turn on your notifications. Every week we bring you clear, honest, and practical information about the financial issues that matter most to seniors and retirees in America. No confusing jargon, no fine print, no fluff. Just real information that you can actually use to protect your money and your future. You work too hard and too long to let the IRS take more than its fair share. Stay informed, stay prepared, and we will see you in the next video.